Well, welcome back to the Small Business Mindset. As I am sitting here in the Midwest under a foot of snow, my new friend Nicole is sitting under a couple inches of snow on the East Coast. But I am excited to welcome a somewhat new podcaster to the world, but she has taken off like a rocket. Nicole Perrone is the host of the Billion Dollar Banker podcast. I love that name. You did a phenomenal job marketing it. But her
Thank you.
background is in mortgage lending, and she works and lives outside of New York City. So a big, big, big market when it comes to real estate. And I know we all probably watch, a lot of the $1 million listings and all those Bravo TV shows that talk about the glamorous lifestyle of that. So would love to hear about all those instances you get to touch. But most importantly, I love Nicole's attitude and enthusiasm for building wealth, for looking at ways that you can grow yourself and, looking how to grow dollars and cents and grow yourself. So Nicole, welcome to the podcast.
Thank you so much for having me, Kirsten. I really appreciate it. I'm excited to be here today.
Could you tell us a little bit about, you shared with me a little bit about who you are and what you do, but what is your day-to-day operations look like and how do you work with people?
Absolutely. Thanks for asking. Yeah, I've been in the mortgage banking industry for over 15 years. Spent 13 years of my career at Wells Fargo. I basically help people, finance the American dream. So if you're looking to buy a home, if you're looking to refinance a home, whether it be second home, investment property, or primary residence, that's what we help with. I run a big team here, a phenomenal group that I work with at Cross Country Mortgage. We're the number one distributed retail lender in the country. We do one in every 37 loans, and super proud to be here and a part of this team, and absolutely love helping people with mortgage financing because it's such an important part of building wealth, and kind of putting people on that journey and helping them accomplish those goals is just truly rewarding. So we love what we do, and we're in a crazy environment over the last couple of years, but I think we're turning the corner.
That's awesome. Well, talk to me about that because that's not an area of business I work in. I know that when I tell people about the residential real estate market, how it compares to the commercial real estate market, for
Hmm.
me, it's not something I really paid much attention to
Right.
until I would say late 2019, before COVID, when in
Hmm.
a lot of our communities, we were scrambling to find new housing inventory. And from an economic development standpoint, I thought, hey, as I'm working with those recruiters to bring in new companies to locate in our metropolitan area, one of the questions they ask is about housing stock. So if I'm going to bring 200, 500,000 employees to your area, where are they going to live? And prior to that fall of 2019, I could say, great, yeah, we have these new neighborhoods, we have these new builds coming. And I couldn't say
Hmm.
that. And that actually hit me like a 10-foot brick saying,
Oh
oh my gosh,
yeah.
what's happening? So talk us through that market. What is the housing market doing? Back up 5 years. Talk about
Yeah.
pre-pandemic, through the pandemic, and then what can we expect going forward?
Yeah, I think obviously, go back to the pandemic, right? Where all of a sudden the Fed funds rate dropped to 2%, and rates absolutely plummeted. We had, historically low 40-year low mortgage rates. We've never seen it before. It was a wild environment. At that time I was in Manhattan, and it was booming. There was a lot of interest in the affluent clientele space for interest only financing. I remember doing ARM mortgages for, below 2%. Some of them were below 2% on an adjustable rate loan. It was just absolutely an incredible time. It was one of the busiest mortgage markets that we saw. Our office at the time funded $2.1 billion in business in just 1 year. And it was a team of almost 20 bankers. So it was absolutely phenomenal results that we had. But, then we took a big turn in the market, right? We saw, rates move up pretty quickly. And I think it kind of shocked the market a little bit, right? Because everybody was really getting very comfortable and very used to seeing the rates very low, and then all of a sudden, it was a large jump up. We're almost in the 8% range and higher. For a lot of people, we've kind of temperamented and brought it back down. We saw the sixes this year for a little bit. Now their average 30-year fixed mortgage is about 7% right now. And so, it's kind of like this conundrum we're in, where we have high rates, we have low inventory of a lot of people that really aren't selling because, they're going to give up that 3% or 2% interest rate for a 7% rate. So you see a lot of people kind of holding on right now, waiting. But then you also see people that are finding the right deals. And when you find the right deal, even if, the rate's a little higher than you'd like, you go for it. And, clients are certainly winning in those cases too. But, when you look at Mortgage Bankers Association and their projection for next year,
Mhm.
I actually just saw it today. For Q1, Fannie Mae is projecting that interest rates are at 6.6% on average on the 30-year fixed. And then, Q2 a little bit lower at 6.4, Q3 a little bit below that at 6.3, and then by the end of Q4, 6.2%. So not really a major change from where we are today, right? So for people that are like, hey, I want to buy something, or I want to invest in real estate, but I'm going to wait. You may be waiting another year and only seeing rates go down, 0.75%, which isn't really that material for payment, so, and affordability.
So no,
So I would say
historically,
don't wait. That would be
oh yeah,
my advice.
right. They're not going back to the twos and threes again, is what you're saying.
Yeah.
So,
I don't think we're going to see, you always get scared to say, like, don't never say never, but we're
right.
always surprised in this world. But at the end of the day, yeah, I think that was a once in a lifetime thing. And, I think sixes are kind of like normal, right? It's kind of like a normal market. So hopefully, 2025, this is what we'll be seeing, more of a normal mortgage market.
Mhm. So historically, becoming a homeowner is
Mm-hmm.
probably one of the greatest ways you can build wealth within your own personal life. How have you seen, I mean, outside of interest rates, because I feel like that's not something we can control necessarily.
Right.
Have you seen less home buyers come to the market? Meaning, I know when I was younger, kind of the American dream, like you go to college, you find a mate, you commit to a long-term relationship, you buy a house, you have a
Mm-hmm.
kid, that's kind of the progression. I feel like that's not the order we go in anymore. Have you seen,
Mm-hmm.
because of the economy, younger people especially, not wanting to be homeowners, or people not wanting to be homeowners in general?
Yeah, so, one of the interesting statistics is that there are more single women that own homes than single men,
Oh, interesting.
which is, I think, the first time in history that that's happened, and that was just the last year that those were those statistics. People are obviously, they're getting married a little bit later in life, they're forming families a little bit later, so we are a little bit more of, I think, a renter nation than we really should be. And when you look at the home ownership rates, and that the rate and pace at which the percentage of people in the country own homes, it's
Mhm.
still that we haven't moved the needle enough. There's been a significant push in the mortgage market, though, for what we like to call like diverse segments, or low to moderate income communities or underserved communities, to help them be able to buy homes. So there's a lot of stimulus, in down payment assistance for people that are looking to buy either their first home, or are moving out of a low to moderate income area, or maybe have income that's under the median area income in a particular area. So specifically in New Jersey, as an example, we have something called New Jersey Home Mortgage Finance Agency. They're
Okay.
giving down payment assistance for first time home buyers of up to $22,000 if you're a first generation homeowner. I just closed a loan for a first time home buyer who got the $22,000 from the state. And there are some restrictions that come along with it, like you can't pay pay off the loan for a period of time, but you get $22,000 in down payment assistance,
That's
or up
huge.
to that. Yeah,
Yeah.
so there's a ton of benefits out there. For your listeners, if they have children that are looking to buy their first home, or if they themselves are looking to buy their first home, it's absolutely, there's so much out there, more than ever before. So even though the rates are a little higher, the ability to leverage some of these programs are greater than they've ever been. I've been doing this for 15 years. And in addition to that, I heard this crazy statistic that the average renter will spend over $300,000 in their lifetime on rent before they purchase a home. So just think about that.
Oh,
You
yeah.
you pay 100% interest when you rent. 100%. Every
Uh-huh.
penny of that payment is just it's
There's no
gone. It's
equity,
not
yeah, whatsoever.
exactly. So I'd say 7% is much better than 100%.
Talk to me about down payments. What does that look like for first-time home buyers versus non-first-time home buyers?
Yeah, so the minimum down payment requirement on a conventional mortgage, so long as you have good credit and not a high debt to income ratio, you could do 3% down. So conventional lending, 3% down. You would have mortgage insurance traditionally whenever you're putting down less than 20%. But there are some programs where there's no mortgage insurance for 3%. down. And again, that kind of goes back to the area median income, where you're living, where you're moving, some of those components. But yeah, conventional financing is the predominant method of financing homes. It's 80% of the mortgage market is conventional financing. If people have credit challenges, usually FHA, or higher debt ratios, FHA, and FHA is still requiring 3.5% down. So the nice thing too is you can get sellers concessions where sellers can contribute towards your closing costs. So when you structure an offer, you could structure it where, hey, I'm going to offer you $310,000 for this house, but I'd like you to cut back 10,000 of that 310 toward my cost, because I only want to come to the table with 3% and save as much as I can. And that's possible too. We also have great programs where you can buy down the interest rate for a temporary period of time. So people can actually either with their own money buy down the rate for a period of time, or they can have the seller buy down the rate for a period of time too, temporarily. So you can actually, if you wanted to, if you get the seller to contribute towards your costs, you can actually have them buy down the rate for the first year, second year, or third year up to 3%. So there's actually a formula and a calculation for that. So there's a lot of little kind of programs and products and assistance that you can get. If you have that kind of consultation and that first conversation, you might be surprised what you find.
That's really fascinating. I never thought about that way. It's been a little while since I bought a house.
Yeah. Are you, go ahead.
Go ahead.
No, I was going to say, when's the last time you took a mortgage out?
We refinanced during the pandemic because I
I
love those crazy low rates. So yes.
Mm-hmm. It's like everybody refied then, and they're not going anywhere until.
Nope, not going anywhere. So,
exactly.
You had a couple of things that I think would be very important to anyone that's listening to this: debt to income ratio and credit score.
Sure.
And so talk me through what that looks like, what's included in debt to income ratio, because not everything is, but a lot of things are. And what's a good debt to income ratio to have?
That's an awesome question. So your debt to income ratio, there's two ratios that are involved in that. One is like your housing ratio, and the other is your total debt to income ratio, your front end and your back end. So your housing ratio is just your monthly housing obligation. So the new mortgage with the taxes and insurance divided into whatever you're making. So if your new mortgage is $3,000 all in and you make $10,000 a month, then your debt to income ratio is 30% for the housing portion.
Okay.
And let's say you had another $2,000 a month in credit card debt. So you have your new housing payment of $3,000, you have $2,000 a month in credit card payments, student loans, car payments, whatever. So that's $5,000 total, and you make $10,000 a month. Now your back end ratio would be 50. So, so that would be, you'd have a ratio of 30 over 50. So essentially, where you really want your total debt to income ratio to be between all the liabilities on your credit and your housing is you'd like it to be at, somewhere between the 45% or under. You can go up to 50% or lower, in some instances over 50% with exceptions and if there's compensating factors. But I'd say general rule of thumb is you really don't want any more of 40% of your gross income to go towards all of your expenses.
Okay. And remind our listeners what gross income versus net income.
Yeah. So, we're in partnership with the government, that. So we, if you're making, $10,000 a month, maybe you're coming home with, $7,500 or $8,000. We won't deduct, your taxes that you're paying. We won't use your net income. We would use that gross amount to qualify you. So that's a good thing for people that are W-2'd.
Absolutely. Because that makes a difference. Okay. Then let's specifically talk about all the things that are considered debt when, especially when we're looking at pulling credit reports and all that kind of stuff, and what isn't considered debt.
Yeah. So your credit report is going to report on things like, student loans, credit cards, any installment debt that you have, maybe personal loan from a bank or something like that. Your car payments, anything you lease or own that you have a payment on. And those are, the predominant things that you'll see on someone's credit report. All the other things that you pay for, like car insurance and cell phone bills, none of those things are included. So it's just what's going to come up on your credit report, what your minimum monthly payment is on those payments. So, if you have an Amex card and it's got a $5,000 balance, the minimum payment's $100. That would go towards that monthly expense for you.
Gotcha. Okay.
Hmm.
Let's flip the switch for a second and talk about
Sure.
credit scores. I feel like, there's no cookie cutter approach to a perfect credit score,
Yeah.
but how are ways what is considered a good credit score?
Yeah.
And what is considered one that's a little more challenging, and how can they increase their credit score?
It's an awesome question because a lot of people will be surprised here. A lot of people are surprised when they hear that you could put down less than 20% to buy a home. Like they're in shock when they hear 3%. I think the general public kind of listens to the news, and sometimes the headlines don't really portray it the right way. And the other thing, the big myth buster is what kind of credit do I need? So a lot of people are walking around thinking I need 20% down, I have excellent credit. But conventional guidelines state that you can go down to a 620 minimum credit score, and FHA, you can go down to a 580 with 3.5% down, but you could go down to a 500 if you have 10% down. So,
Oh, okay.
yeah, there's really, that surprises a lot of people when they hear it, but the reality is that there are options. A lot of times, if you're seeking conventional financing and your score's in a 620, like you're not going to be able to put down only 3 or 5%. You might have to put down more money if your credit score is low, but
Hmm.
you absolutely can get financing. I'd say really, you probably want to be somewhere between that 680 and 740 to be in the space where you can get the most amount of money when you're purchasing.
Yeah.
The best way that you can keep your credit in check, I think, is just to keep low balances and pay things over time. So if you have a credit card that has a $10,000 limit, try to not have a balance of anything more than 3,000 or 30% of that amount, and just pay that consistently on time as often as you can. Make sure you're using credit and you're building your credit through time. So if you don't have credit today, start building it as time goes on, because you will need to kind of have that ready when you do get a loan. There are ways that we can actually do financing for people that don't have credit. We can build what's called non-traditional credit, and that's the ability to take things like cell phone bills, car insurance, things that are not customarily on your credit report. And we
Hmm.
actually can contact those creditors, and we can actually build our own kind of credit score, non-traditional credit for that client.
Interesting.
Yeah.
Okay. What's the best way for someone to get started and get credit in general?
Yeah, so I think if you have a child, I think making them an authorized user on your card, even if you never give them a card, is a great way to get them started with building credit, because it'll report, so they'll have that kind of credit building, you paying the bills on time. But you could start by going to your local bank and seeing if you qualify for a credit card. If for some reason you don't, you can get what's called like a secured credit card, where you put in the bank, let's say $2,000 in a bank account, and they actually kind of give you like a line of credit against your own money, and they have your money there. So if for some reason you default, you don't pay, they already have the money at the bank. So that kind of makes them feel comfortable. It's a great way to build credit for people that may have bad credit right now, aren't able to get approved for a card, or just for some reason can't get one. Secured credit card's a good option.
Hmm. That's awesome.
Yeah.
Let's talk about bankruptcy for a minute, because I have,
Mhm.
come across some clients over the years, and people that I know, and, for whatever circumstance, they needed to file for bankruptcy.
Sure.
How do mortgage lenders look at bankruptcy on a credit report?
Yeah, so here at Cross Country, we work with almost 100 different lenders. So there are some lenders that will allow for bankruptcy, a recent bankruptcy, and still do lending. FHA usually requires, I think off the top of my head, that FHA requires a couple years that passed since the bankruptcy, but it's certainly not like a hopeless situation. There's even lenders out there that will provide financing if you had recent mortgage lates. So they're, again, you're not going to get the greatest financing terms. You're not going to get the best rates, and that's kind of the hard pills to swallow in those situations. And sometimes then affordability becomes a factor. But there are options for people that have gone through hardship. It's you're best served when you work with a lender like ourselves, or a correspondent lender. So essentially, we underwrite and close the loans here, but we can send them to a variety of different lenders based upon product. So if you came just to one lender, they might say, well, oh, I'm sorry, our minimum credit score here at this institution is 680. They could say that. We don't lend under that. Even though Fannie Mae and Freddie Mac will allow for 620, we don't allow for it, right? That's the lenders are allowed to put in overlays. When you come to a bank like ours, a correspondent lender, essentially we're able to say, okay, well, you know what, this person has a 580 credit score and they had a bankruptcy in the last 2 years. Let's figure out which one of our lenders will allow for that, or which one of, with a variety of products. We do lot loans, we do bridge loans, we do home equity lines of credit, we do reverse mortgages, we do renovation loans, we do a whole slew of different types of lending for people that really help them, be able to know, like, hey, when you hit our desk, we're going to give you all the options that are available in the market.
I love it. Yeah.
Yeah.
And thanks for explaining it that way, because I think
Sure.
I've used insurance brokers over the years, but I never thought about the mortgage industry in that way as well. And being able to basically, you have a smorgasbord of
Mm-hmm.
different pockets that you can plug into based on the client's needs. That's great.
Yeah, and it was one of the reasons why after 13 years working for a large national lender, running a large team, I decided that the correspondent place was the place to be. Actually, majority of the mortgage business that's done is written in on the mortgage, with mortgage lenders, not necessarily with banks. So,
Right.
and it's a disservice sometimes when someone will call in and speak to someone at a bank and they'll say, you can't, sorry, I can't get you approved. And then the conversation kind of ends there. It's not like, well, go call a correspondent lender. Maybe they could help you. And so someone might think that they can't get financing when they actually can. And so we do a lot of non-QM lending here is a big part of what I specialize in. And basically what that is that's alternative income that we can use to get people qualified. So a lot of self-employed clients have very creative financing
Mhm.
or very creative accounting, I'm sorry, and won't really show a lot of net earnings. And so for those customers, we can do 12 months of bank statements to prove income, or we will accept a P&L for 1 year to prove the income, as long as it's signed by a accountant. It doesn't
Mhm.
need to be audited, but it needs to be signed by an accountant. And we do those types of loans all the time. We have clients that just qualify off the assets that they have. So maybe they have $2 million in the bank and they need $1 million loan. We can do a loan for them based upon just the asset qualifier portion of it. So we do loans 1099 only. So, for your independent contractors, your realtors, people that are, they made $500,000 on a 1099 on their Schedule E, they wrote off half of it. So they lose that income when they would go to a traditional lender. Maybe they can't qualify now because of that. Here, we would just look at the 1099 only to qualify them. So they're phenomenal programs. And for investors, we have what's called the investor cash flow loan, or DSCR loan. And that allows investors we don't even look at a debt to income ratio. All we look at is the property that you're purchasing.
Mhm.
And if the rent debt services, if the rent covers the mortgage payment or cash flows above it, you can get a loan just based off of that.
I
So
love that.
really, really great programs. Is a lot of times our clients are turned down elsewhere and they come to us and find a place to get it done.
Mm-hmm. That's awesome. You've given us a lot to think about. I mean, and I
It's
hope
good
that,
stuff.
if you are not already a homeowner, you're listening to this or watching this and are considering, or are just considering, seeing what's out there. It's a great way to build wealth. It's a great way to understand your finances, understand not only what you can afford, but how to build equity, in your
Yeah.
home and in your life. So this is a great conversation.
Right. And it's absolutely free to, go through the process of having an initial consultation and doing an application. We do, like a soft credit pull. So it's not a hard inquiry on your credit report. And we're able to tell you, what you can qualify for and what the numbers look like. So, if you are someone out there today that's been contemplating, feel free to reach out to someone, reach out to me. We'd be happy to help you and, just give you the information you need to make the right decision.
Awesome. Nicole, what's the best way for them to get in touch with you?
My social handle, as you said before, on everything online is @BillionDollarBanker. Would
Uh-huh.
love for you guys to follow me there and check out what we're doing. You could certainly email me at nicole.perrone@ccm.com, and we can get started there, and then we can talk through the process. Usually, doing a pre-approval, going through your application could take somewhere between 15 to 30 minutes, and maybe we have like an hour-long discussion about everything there is mortgage, and then you make the decision that's best for you.
Awesome. Well, thank you for joining us. This has been so insightful, and I encourage you to get in touch. So I appreciate it.
Thanks so much. I'm so happy to be here. It's an honor. I love what you're doing here, Kirsten, and I'm glad we were able to get connected.